Okay, welcome to the Borr drilling deep analysis. There are six parts. The first one is disclaimer, the second one is executive summary, the third is business segment, the fourth is fundamentals, the fifth is risks, the sixth is conclusion. Okay, disclaimer. This report is for personal opinion sharing only and does not constitute investment advice for any entity. The market is risky and the investment should be made with caution. It is not intended to harm the interests of any entity in any malicious way. O- uh, Second, excuse summary. Ultimate pricing power, supply-side clearance, unmatched cost advantage, young and high-efficiency fleet with standardization of the same models, cycle reserve, gradual recovery of the industry cycle. Third, business segment. The first point is core business. As a shallow water drilling contractor at a depth of about 400 feet, the company owns a fleet of jack-up rigs, undertaking oil and gas exploration, production well workover, well plugging, as well as carbon capture and storage. Shallow water reserves are typically the cheapest source of hydrocarbons, with low geologic risks, shorter cycles, and cleaner operations. Despite their relatively low hydrocarbons resource density performance, the company secured 24 new contract commitments through the year, totaling 5,000 operating days with a value of $649 million. The technical utilization rate reached a high of 98.8% and the economic utilization rate 97.8%. The contract coverage rate is 80% for the first half of 2026 and 48% for the second half. The average daily rate is signed contracts in is $158,000 per day. The daily cost is about 50,000 to 55,000 US dollars per day, with a break-even point ranging from approximately 59,000 to 64,000 US dollars per day. Scale: the company has reached an agreement with Noble Corporation to acquire 5 high-end jack-up rigs at a total purchase price of $660 million with a completion schedule for January 2026. After the acquisition, the total number of jack-up rigs will reach 29 units. Outlook: the management stated that the market has bottomed out and rebounded. A number of tenders are in progress in the Middle East, which are expected to provide long-term contracts for certain jack-up rigs. In Mexico, Pemex announced a 34% year-on-year surge in upstream capital expenditure and has been granted production increase authorization. The utilization rate of high-end drilling rigs under some market contracts remained stable at about 90.3%. As tender authorizations are issued and available, supply is absorbed. The company expects the market conditions to stabilize, which will support the improvement of pricing and profitability. Management: the company has a world-class HSE management system and won the HSE award, the IADC award, and PTTEP SHE reward. Benefits of high HSE ratings: lower financial costs, interest rates reduced by 0.5% to 2%, stock price support, inclusion in passive index funds such as HSE and ESG, competitive advantages, priority in winning tenders, reduced insurance costs, lower premiums, and insurers are more willing to underwrite risks. Government-friendly policies, a faster progresses, and MA premium. Cost advantages: the advantage fleet age is only 8 years, which means high efficiency and low cost. The 29 jackup rigs are mainly of two models, enabling standardization in inventory, maintenance, and staffing, which further reduce the marginal cost. Supply side clearance. This is the most important thing. Okay. Companies such as Samsung, Heavy Industry, and Hanwha Ocean has not retained relevant production lines, and their capacity is fully occupied by LNG and VLCC carrier orders, which means there will be no rig supply and the company existing competitive advantage will be sustained in the long term. The industry's characteristics of high investment, long cycles, low returns, and high uncertainty are a nightmare for capital. Curbing the inflow of external capital. At the same time, ESG issues also lead to financing difficulties. Flexibility. Jackup rigs can be redeployed to regions with the highest daily rates instead of being fixed in the same place. Fourth, fundamentals. Revenue. The revenue in quarter four 2025 was $259.4 million, a quarter-on-quarter decrease of 6%. yet it exceeded the market expectation of 239 million US dollars. Profitability: the adjusted EBITDA in quarter four was 105.2 million US dollars, a sharp quarter-on-quarter drop of 22%. The annual adjusted EBITDA was 470.1 million US dollars, a quarter-on-quarter decrease of 7%. The net loss in the quarter was 1 million US dollars, a quarter-on-quarter reduction of 28.8 million US dollars. The annual net profit was 45 million US dollars, a significant quarter-on-quarter drop of 45%. Liabilities: the company issued new 5-year senior secured notes with a value of 165 million US dollars and an interest rate of 10.375%. The total liabilities are about 3.6 billion US dollars, with an average interest rate of 9% to 10%. Cash and cash equivalents totaled 397 million US dollars, with an addition 234 million US dollars of undrawn revolving credit facilities. Assets: the company owns 29 jackup rigs. Based on replacement cost estimation, each rig is worth about 300 to 350 million US dollars, with a service life of about 40 years and average lease age of around 80 years. The fifth, risks. The credit market has extreme concerns about the company's debt repayment capacity. The interest rate on the highest priority asset-backed notes is as high as 10.375%, and the high interest rates will continue to erode profits. The interest expense EBITDA ratio is as high as 76%, reflecting high operating leverage, and the company's resilience is worth of attention. Macroeconomic uncertainties, such as OPEC's production increase, may further suppress oil price, thereby driving down the company's daily rates. A small number of clients, including Pemex, has a history of delayed payments, so the cash collection cycle is worth our attention. Okay, the final conclusion is for patient long-term investors, it might be an investment target worth of attention. Okay, thanks you guys.